Hey everyone, this is Mish Schneider, Chief Strategist of MarketGauge.com, bringing you your weekly update, commodity focused of course because it's so interesting. And we have a lot of data coming out this week in the US, CPI, PPI, we had some small business numbers this morning, consumer confidence, and also we have a tremendous amount of controversy going on amongst economists and not so trained economists alike on money supply, meaning disinflation, whereas all I'm seeing is many commodities continuing to fly. So let's see if we can come up with some actionable information ahead of these numbers. CPI is expected to be unchanged. I believe that that's probably going to be the case. IMF came up today and said that they were going to pause in terms of raising rates. I think the Fed might do something similar. Of all of this, of course, may be perceived as positive for the market initially, but my prediction is still that commodities will continue to outshine, and at some point the Fed will realize that once again they've lost control of inflation, and then they will have to get aggressive again. But that's just my speculation. If we look at the dollar here, this is just pure dollar, not dollar against the euro. You can see that so far what we're getting based on a cash settlement is some support at around 102, 101. Should that level break, and we looked at longer term charts, you would see that 97 is not only a good area on the daily chart and on the weekly chart, but it's also a good area even on the monthly chart, this is where the 80-month moving average sets in. So this will be an important area. Can we see pops along the way? Absolutely. But what you see in these pops right now is that they're very short-lived and they're met by a lot of selling. Let's look at the daily chart on this. And on the daily chart right here, we can see that it's in a bearish phase, right? Everything has broken down. It's below the 200-day, the 50-day. It did do a little bit of popping recently back over the 10-day, but actually right now it's sitting a little bit lower here. This is end of day cash settlement only. But nonetheless, once again, you can see that that 101 level is going to be important. This looks like a giant head and shoulders top. I'm not even going to get into the controversy on whether or not it remains world reserve currency. One thing we do know is that many countries are uniting, including France, in trying to move away from the USD for all kinds of reasons. So if this head and shoulders actually turns out to break down, you've got a pretty nasty measured move down to around 96, 95. So that's something we're looking at. Where would I change my mind? It would really have to show me a close back over the 50-day moving average, or right now back above 103, 103.25. Moving along right now, we also have a situation with oil. Now, I had talked to you about $82 a barrel with oil. That was going to be my number. Now you can see that we have not really been able to get through 85 for any sustained period. And look on this daily chart, this type of consolidation that you're seeing here. Also of interest here is our real motion momentum indicator, showing that the momentum is actually over the 200-day moving average. It took out the 50-day moving average a while ago. Is flirting with the Bollinger Band here. One could say a potential mean reversion, except if we're looking at crude as I'm speaking to you right now, we are definitely seeing a situation where the prices are going up. And one of my favorite indicators, even though it's more US-centric, is USO, where you can see just the opposite is happening. This is taking out the 200-day moving average, the big gap, and also right now is challenging the Bollinger Band on the momentum indicator. So I would tend to believe this chart more than I would believe right now the Brent end-of-day futures chart. And just to confirm, let's take a look here at the light crude oil chart. Looks very similar. Of course, I was quoting 82 and 85 in Brent, but if we look at this one, we can say really at this point now it has to hold around $79, $80 a barrel. And if we can get back up through, let's say 80, 81, 82, kind of same levels, then we're going to be looking at a move up to the 200-day moving average at 84. And once again, momentum is here, but also potential mean reversion, which what I mean by that is when you get above the Bollinger Band, either on the downside as we saw here, and a mean reversion to the up, or the mean reversion to the down, and that would be if it breaks the Bollinger Band. But it hasn't happened yet. So right now we'll take a look and see. I'd say probably the easiest thing to look at is this period of consolidation and make sure that we don't start to look at some kind of gap fill, because then that would be more negative and more in line with the calls for potential recession using the oil prices as a gauge. But at this point, I am not convinced. Okay, let's also then move on to another one of our favorites, and that is natural gas. This is another end-of-day contract using stock charts for natural gas, but there was a big rally yesterday off the lows. And when I say a big rally, considering how beaten up this instrument has been, big is a relative term. But nonetheless, we are potentially seeing a divergence in the momentum here, and that this is hitting right at the 50-day moving average, which we would like to see clear. While this is still relatively, and I say relatively, far from the 50-day moving average. Now, natural gas, looking at is actually at this point also still up. So let's say if indeed we had a tradable bottom here, what we'd be able to look at is a risk just under 2. That's kind of tight. And buying it on the basis of it clearing the 10 in anticipation that at the very least we can go up to 245 and possibly up to 3. But I would play this in very short-term increments. And again, this is being used as a recessionary indicator, and it is possible. I wouldn't say it isn't. I'd much rather be a buyer of oil than natural gas, but it is possible that this has actually bottomed. Now, in terms of semiconductors and all of that, of course, we also know that a big situation is potentially occurring with China running drills around Taiwan. And we also just recently had some kind of an earnings report in Taiwan Semiconductors, which was not good. And so considering that the entire U.S. economy right now is so much staked on tech and semiconductors, considering the rest of the market has barely done anything more than a bear market rally, and that includes regional banks, that includes retail, that even includes transportation, although that's doing a little bit better today. So demand has picked up, which is good, and we'll take a look at those. But just looking right now at the my goodness, I'm sorry. Let's look at the semiconductor space here. And looking at the semiconductor space, what's really interesting is that this obviously broke out a while ago, and we did have a little bit of a mean reversion here. So that's why these momentum indicators work really well. But we held the 50-day moving average, which also happens to be very close to the 80-month moving average. This is actually still in an expansion cycle. And what we know is that the anticipation here is exactly what I showed you, that oil won't go further, that inflation is under control, that the Fed will maybe do one more hike and then pause. All of this is giving life to the semiconductors, of course, also with discounting at this point that we take the next step further in terms of China and Taiwan. We know that's going to be disastrous. But if you just look at the charts right here, if this breaks down under 247 and confirms that, that would certainly not be good for the chip space. And looking at some of the individual chip stocks, which, by the way, we have in terms of our quant models, although we've taken profits in, Nvidia being the head kingpin here, that's still looking pretty good. Although, if we look at momentum, it's starting to wane a little bit, while price is still sitting up on this 10-day moving average, which tells me right now that unless we really break down under 260, I had a target, by the way, of 275. It got to 280. If we break down under 260 or we get back through 275, then maybe things aren't as bad as they seem. And of course, we have to realize too that we're just starting to get into earnings seasons. The best place to look in terms of the equities remains the 23-month moving average. And so this tells the whole story right here. We talked about the fact that the SPY got right up to it and hasn't been able to close a month above it since the breakdown that we saw here in 2022 in May, almost a year ago. that we've had the diamonds get through it, which is the industrial manufacturing side, which also includes some defense stocks, which of course have been performing well. But at this juncture right now, we're still below it. If we move up here quickly to NASDAQ, where the semiconductors space actually lies, this too has not been able to get through its 23-month moving average. And this, of course, is nowhere near. So really what this leaves us is with the inflation numbers potentially showing some near-time cooling off and a Fed misstep. But with geopolitical headwinds and a dollar right now that is losing some of its purchasing power, regardless of what you think about the world's reserve currency, and the fact that we have the long bonds actually still holding up pretty well, and we have calls for both recession, and we have calls for hyperinflation, and we also have calls for disinflation on top of recession. Really, you just have to look here. One catalyst could drive inflation much higher and drive the indices much lower. But in the meantime, should we get expected CPI numbers and we don't see things really flare up yet as in terms of what's happening in Asia, then it's possible that we could see the diamonds go back up through the 23-month, then that would be followed probably by NASDAQ, then SPY, and maybe that rally would be insofar as we can get the small caps back up to around 196, and if they can't get through, because that's based on real growth, by the way, then that stops the rally. So that's the prediction right now. We're still in stagflation, not necessarily the classical definition. The gold market, the silver market, the sugar market, all of those look great. DBA, the Ag ETF, and DBC, and oil, all starting to look interesting, along with copper and steel and coal, tech, so TECK. So keep in mind when you're trading right now to watch all of these factors and be prepared to go in either direction as we start to see what happens here as we get through all this economic data. And two most important areas to watch right now would still be, yes, the semiconductors, obviously, but also the Russell 2000, because this would really be the indication, if we break down here, that perhaps that stagflation is getting more like stagnation to slow down while the cost of goods continue to rise. Thank you so much for